Hey, what's up everybody, Jack Harper here. Getting started in trading can feel like stepping into a whole new world. You've got charts, graphs, and more numbers than you can shake a stick at. It can be overwhelming, right? We're breaking down the top trading indicators that every beginner needs to know. Think of these as your secret weapons in the market. These indicators help you cut through the noise and see the bigger picture. We're talking about the RSI, the MACD, moving averages, Bollinger Bands, all the good stuff. So, buckle up, hit that subscribe button, and let's get you trading like a pro. Alright, let's kick things off with the RSI, or the Relative Strength Index. This is one of the most popular momentum oscillators used in technical analysis. Think of the RSI as your own personal hype meter for the market. It helps you gauge the excitement or the lack thereof in the market. It measures the strength of price movements on a scale of 0 to 100. This scale helps traders understand whether a stock is overbought or oversold. When the RSI climbs above 70, it's flashing a warning sign that things might be getting a little too hot in the market. This could indicate that the stock is overbought and might be due for a pullback. Conversely, when the RSI dips below 30, it could be signaling that the stock is oversold and there might be an opportunity to buy low. This is often seen as a potential buying opportunity. The RSI is a powerful tool, but it's not foolproof. It's important to remember that no single indicator can provide all the answers. It's not a crystal ball. It won't predict the future with absolute certainty. Sometimes a stock can stay in overbought or oversold territory for a while, especially if there's a strong trend in play. This is why context is crucial. That's why it's crucial to use the RSI in conjunction with other indicators and your own analysis. Combining different tools can provide a more comprehensive view. Looking for confirmation from other indicators is key. This helps to validate the signals you're getting from the RSI. For example, if you're seeing the RSI in overbought territory, and you're also noticing a bearish divergence on the MACD, that's a much stronger signal that a reversal might be in the cards. This combination can give you more confidence in your trading decisions. Remember, trading is all about managing risk, and the RSI is a fantastic tool to help you do just that. It helps you identify potential entry and exit points. It gives you that early warning system, highlighting potential overbought and oversold conditions so you can make more informed decisions. By understanding and utilizing the RSI, you can better navigate the complexities of the market and improve your trading strategy. Alright, moving on to another heavy hitter in the world of trading indicators, the MACD, which stands for Moving Average Convergence Divergence. This indicator is a favorite among traders for its ability to provide clear signals about market momentum and potential trend changes. The MACD is all about momentum. It helps traders understand the strength and direction of a trend, which is crucial for making informed trading decisions. It helps us visualize the strength and direction of a trend, and it can even give us clues about potential trend reversals. By analyzing the MACD, traders can get a sense of whether a trend is gaining or losing steam. The MACD does this by using two moving averages, a faster one and a slower one, and it plots the difference between them as a line, called the MACD line. This line fluctuates above and below a zero line, providing a visual representation of momentum shifts. When the MACD line crosses above the signal line, it's often seen as a bullish signal, suggesting that momentum is shifting to the upside, and it might be a good time to consider buying. This crossover indicates that the faster moving average is starting to outpace the slower one, signaling a potential upward trend. Conversely, when the MACD line crosses below the signal line, it can be a bearish signal, indicating that momentum is shifting down, and it might be time to consider selling or shorting. This suggests that the faster moving average is falling below the slower one, hinting at a potential downward trend. The MACD also throws in these little gems called crossovers that can give us even more insight into potential trading opportunities. These crossovers are key moments where the MACD line intersects with the signal line, providing clear buy or sell signals. You've got your bullish crossovers, which happen when the MACD line crosses above the zero line. This is a strong indication that the market might be entering a bullish phase, and traders often look for these signals to time their entries. Then you've got your bearish crossovers, which occur when the MACD line crosses below the zero line. This suggests that the market might be entering a bearish phase, and traders might use this signal to time their exits or short positions. But when used correctly, The MACD can be a powerful tool in your trading arsenal, helping you ride the waves of momentum and potentially identify profitable trading opportunities. By understanding and interpreting the signals provided by the MACD, traders can make more informed decisions and improve their chances of success in the market. Let's talk about moving averages, one of the most popular and versatile tools in a trader's toolbox. Moving averages help traders and investors make sense of the often chaotic and noisy price data by smoothing out short-term fluctuations. At its core, a moving average is simply the average price of a security over a specific period. This period can be as short as a few minutes or as long as several months, depending on the trader's strategy and goals. It's called a moving average because it's constantly recalculating as new price data comes in, smoothing out those short-term fluctuations and giving you a clearer picture of the overall trend. This continuous recalculation helps traders stay updated with the most recent market conditions. You can calculate moving averages over different time frames, depending on your trading style and the time horizon you're looking at. For instance, day traders might use shorter time frames, while long-term investors might prefer longer ones. Shorter-term moving averages like the 10-day or 20-day are more sensitive to recent price movements. They react quickly to price changes, making them useful for capturing short-term trends. Longer-term moving averages like the 50-day, 100-day, or even 200-day are much smoother and less prone to those short-term fluctuations. These are often used to identify the overall direction of the market. One of the most common ways to use moving averages is to identify crossovers. A crossover occurs when a shorter-term moving average crosses above or below a longer-term moving average. When a shorter-term moving average crosses above a longer-term moving average, it's often seen as a bullish signal, suggesting that momentum is shifting to the upside. This is known as a golden cross. On the flip side, when a shorter-term moving average crosses below a longer-term moving average, it's considered a bearish signal, indicating a potential shift in momentum to the downside. This is referred to as a death cross. Moving averages can also act as dynamic support and resistance levels. Prices often tend to bounce off these moving averages, making them useful for identifying potential entry and exit points. Experiment with different time frames and combinations of moving averages to find what works best for your trading style and risk tolerance. By doing so, you can tailor your approach to better suit your individual needs and market conditions. Let's dive into the world of Bollinger Bands, a powerful tool designed to help you understand and even profit from volatility in the market. Bollinger Bands consist of 3 lines plotted around a moving average. You've got the middle line, which is typically a 20-day simple moving average, and then you've got the upper and lower bands, which are plotted 2 standard deviations away from the middle band. The width of the bands expands and contracts based on the volatility of the asset you're trading. When volatility is high, the bands widen, giving the price more room to move around. Conversely, when volatility is low, the bands contract, squeezing the price action closer to the middle band. One of the key principles of Bollinger Bands is that price tends to revert to the mean. If the price has been hitting the upper band for a while, it's more likely to pull back towards the middle band, and vice versa. Another important concept to understand with Bollinger Bands is the squeeze. This is when the bands contract significantly, indicating a period of low volatility. When used correctly, they can be an incredibly powerful tool for understanding volatility, timing your entries and exits, and potentially profiting from those big market moves. Let's wrap things up with the stochastic oscillator, a momentum indicator that can be particularly useful for identifying potential overbought and oversold conditions, as well as spotting potential trend reversals. The stochastic oscillator compares a security's closing price to its price range over a given period, typically 14 periods. It's plotted on a scale of 0 to 100, with readings above 80 generally considered overbought, and readings below 20 considered oversold. The stochastic oscillator is made up of 2 lines, the %K line and the %D line. One of the key ways to use the stochastic oscillator is to look for divergences, which can signal potential trend reversals. A bullish divergence occurs when the price of a security makes a lower low, but the stochastic oscillator makes a higher low. Conversely, a bearish divergence happens when the price makes a higher high, but the stochastic oscillator makes a lower high. Another common way to use the stochastic oscillator is to confirm overbought and oversold conditions identified by other indicators, like the RSI. When used correctly, It can be a valuable tool for fine-tuning your entry and exit points, confirming overbought and oversold conditions, and potentially getting a jump on those market reversals. So there you have it. You're now armed with the knowledge of some of the most powerful trading indicators out there. Remember, these are just tools, and like any tool, they're most effective when used correctly. It takes time, practice, and a bit of trial and error to really master these indicators and find what works best for you. The key takeaway is this: trading is a skill, and like any skill, it can be learned and improved upon. By understanding these indicators and how to use them effectively, you're giving yourself a significant edge in the market. Now go out there and make some smart trades.